Welcome to Finance Insights, where we delve into crucial financial concepts to help you make informed decisions. Today, we're exploring the topic of risk aversion. Risk aversion is the tendency to prefer certainty over a gamble with higher or equivalent expected value. In other words, a risk-averse person prefers a guaranteed outcome over a risky one with the same or higher potential return. Here's an example to clarify. Assume you are given two options. Option A offers a guaranteed $50. Option B is a gamble where you have a 50% chance of winning $100 and a 50% chance of winning nothing. Even though both options have an expected value of $50, a risk-averse individual will choose option A over option B due to the certainty it offers. Let's dive into the concept by looking at a utility function, which represents the satisfaction or happiness an individual gains from wealth. For risk-averse individuals, the utility function is concave. The concave nature of the utility function implies that as wealth increases, the additional satisfaction or utility derived from additional wealth decreases. This diminishing marginal utility is a hallmark of risk aversion. Let's visualize this concept with a graph. In this graph, you can see how utility increases at a decreasing rate as wealth increases. This demonstrates the principle of diminishing marginal utility. Now, to quantify risk aversion, we use the concept of the risk premium. The risk premium is the amount of money a risk-averse individual would pay to avoid taking a risk. Consider an investment with a 50% chance of yielding $100 and a 50% chance of yielding $0. The expected value of this investment is $50. If a risk-averse investor is willing to pay $5 to guarantee $45 instead of taking this gamble, then $5 is the risk premium. To measure risk aversion, economists often use the Aversion measure of absolute risk aversion. This measure is defined as the negative second derivative of the utility function divided by the first derivative. For the utility function U, W, equals SQRT, W. The Aversion measure of absolute risk aversion is calculated as follows. As wealth increases, the Aversion measure of absolute risk aversion decreases, indicating that wealthier individuals are generally less risk-averse. Now, let's discuss different types of investors based on their risk tolerance. We have risk-averse, risk-neutral, and risk-seeking investors. Risk-averse investors prefer certainty over risk and are willing to accept lower returns for lower risk. Risk-neutral investors are indifferent between certainty and risk, focusing solely on expected returns. Risk-seeking investors prefer taking risks and are willing to accept lower certainty for higher potential returns. Now that we've explored the concept of risk aversion, let's look at how it impacts portfolio management. A key principle of modern portfolio theory is that investors can reduce risk through diversification. By holding a diversified portfolio, risk-averse investors can achieve a balance between risk and return. This is achieved by combining assets with different risk-return profiles to minimize the overall risk. Here's a simple example. A portfolio consisting of 50% stocks and 50% bonds is less risky than a portfolio with 100% stocks. The bonds act as a buffer against the volatility of the stock market. To further illustrate, let's visualize the risk-return trade-off for different portfolios. In this bar graph, you can see that while Portfolio A has the highest expected return, it also carries the highest risk. Portfolio B, with a mix of stocks and bonds, provides a moderate expected return with moderate risk. Portfolio C has the lowest risk but also the lowest expected return. Risk aversion also influences the choice of financial instruments. Risk-averse investors typically prefer safer investments like government bonds, high-grade corporate bonds, and dividend-paying stocks over volatile stocks or speculative assets. Understanding your risk tolerance is crucial in financial planning. It helps in selecting the right mix of investments to meet your financial goals while managing the level of risk you're comfortable with. To gauge your risk tolerance, financial advisors often use risk tolerance questionnaires. These questionnaires assess factors like your investment horizon, income stability, and past investment experiences. Now, let's address some common questions about risk aversion. Question: Can a person's risk tolerance change over time? Answer: yes. A person's risk tolerance can change due to various factors such as age, financial situation, investment goals, and market conditions. Question: how does risk aversion affect retirement planning? Answer: risk-averse individuals may prefer a more conservative portfolio as they approach retirement to safeguard their accumulated savings from market volatility. Question: is it possible to completely eliminate risk in an investment? Answer: no. All investments carry some level of risk, whether it's market risk, inflation risk, or liquidity risk. The goal is to manage and mitigate these risks through diversification and other strategies. As we wrap up, remember that risk aversion is a fundamental concept that influences various financial decisions. Understanding your own risk tolerance can help you build a portfolio that aligns with your financial goals and comfort level. Thanks for watching, and don't forget to subscribe for more insights into essential financial concepts.